Disney reported quarterly results that blew past Wall Street's expectations after Tuesday's close. I'm joined by Tuna Amobi, senior equity analyst at S&P Capital IQ. Tuna, strong results for the company pretty much across the board. Are there any holes in this report?
Well, it's really tough, Brittany, to find anything not to like in these earnings. I have to say they really hit the ball out of the park. And I think what's very impressive is the consistency with which they've been really outperforming investors' expectations for much of the past, I'd have to say, 2 years now. So I think the company is really firing on all cylinders.
Well, Disney's studio entertainment business did see revenues that fell 2% and lower theatrical distribution year over year as Big Hero 6 paled in comparison to last year's Frozen, which is easy to do, how big that movie was. What's your outlook for the studio business with Avengers out on May 1st and Star Wars also in the pipeline? Could these have Frozen-type success?
Well, talking about Frozen, I think it's really the gift that keeps on giving. So talk about the franchise pipeline. In all of the years I've covered the company, it's really hard to see any time when the company has a very solid, robust pipeline of films, including major follow-on installments as well as original films. So I think really this really sets up the company well for very solid free cash flow into the foreseeable future. The visibility has never been better. We think the company is on a creative momentum, and we think this is going to generate very significant multi-platform upside. And the company, in fact, called out about 11 franchises that generate north of about $1 billion in annual retail sales, including Frozen. So I think really that gives you an idea of what really, how the visibility is shaping up.
Any concerns overseas as Disney announced plans to push back the opening of its Shanghai theme park to mid-2016? It had been slated to open by the end of this year.
Well, the delay in the Shanghai opening got us a little worried, but we think this is already baked into their estimates. This was not unlike what happened when they opened the Hong Kong park in 2005, and that park eventually got on to really become a significant contributor. We think China is a very attractive market for Disney over the long term, although we think there could be near-term bumps as they look to make sure that they've got a very compelling offering for the local market.
So what is your view on shares of Disney here? What are you recommending?
We have a buy recommendation on the shares. Today, we just upgraded our 12-month target price from $98 to $106, which should push the shares further into all-time high territory. We think this is really a very important time in the history of the Walt Disney Company. The whole thesis of the company has really been changed dramatically from a company that used to be driven by theme parks and media networks, alternately to a company now that's really fundamentally different with consumer products and film studio also contributing greatly quarter in quarter. So I think that really is going to change the perception of the company as an investment.
Really impressive results. Thank you so much, Tuna Amobi, senior equity analyst at S&P Capital IQ.
Thank you.
And I'm Brittany Umar for The Street.